We have another interesting week coming up where we will talk about three topics. The first, decoding the interest rate cycle, where we will talk about what an investor can do in a high interest rate regime and a low interest rate regime. Second, why M2W? If you're still on the fence of whether to join the program or not, this is a webinar for you. Join in to get all your questions answered. The third, the future of auto components, where we will talk about the impact of electric vehicles on traditional auto component manufacturers. So, if you are interested in any of the three, click on the description below. But wait, hold on. To get a list of all the upcoming webinars that we are going to cover for the month, click on the link below the registration form in order to register for any of them.
Are we mispricing growth? This market has seen a number of companies gain significantly in valuation. And one common thread to all these companies is they are either showing very strong revenue growth or promising very strong growth for the next 2-3 years, or claiming that they have visibility of very large order books, or indicating that the size of the opportunity is very large. The TAM, the total addressable market, is very large, and that in turn would create outlier revenue growth. Once investors are kind of convinced on the revenue growth, they immediately assume profit growth. But history tells us that in many industries where revenue growth is very high, it does not guarantee profit growth. For instance, in businesses like contracting, EPC, you can create very large bills. You can bill for big projects, but you won't make money. If you look at the last bull market in capital goods and in growth related industries and infrastructure, one common factor is that companies which tried to grow the fastest went bankrupt. Companies which were conservative survived. So today, nearly 19 years later, we are again chasing the same type of companies which in that cycle went bankrupt. But there can be an argument, this time it's different. And when you try to probe further as to what people are claiming is different, they are bringing out the government as the protector, some kind of a guardian angel, saying that government will invest, government policy will protect these companies, and visibility can be taken for granted. Here again I have a very differing view, and that is, when companies see that it is possible to gain so much valuation by building visibility of revenue or convincing investors about visibility of revenue, the number of entrants into such businesses would be very high. Everybody who is not in that industry thinks of entering that industry. In fact, many of the people you are seeing today are very recent entrants into this kind of businesses. So there will be many more, and when you have many more, this same revenue pool is going to be chased by twice or thrice the number of companies. What would happen? First, the profit pool will shrink, and then you will start seeing the profit pool even turn negative as people are more desperate to chase revenue and create order books based on which they can raise a lot of capital and pursue more and more opportunities to set up different businesses. Here again, the priority of the investor and the priority of the entrepreneur are heavily in conflict. But the investor thinks that they are completely in sync. This is because investors fail to read beyond the obvious. Entrepreneurs know the real value of their companies, know that their companies are overvalued. And they know why you are actually wanting to buy their companies much better than the investor knows. And to them, it's very, very obvious that this opportunity is too good to pass and they must raise capital using which they can create a slew of new business opportunities for themselves, which will in turn give them further opportunities to become richer, because when you set up multiple businesses, each business becomes more valuable. So the entrepreneur sees this whole thing as capital raising opportunity, but the investor sees this as value embellishing or value creating opportunity. For some time, both are in complete sync, but at a particular stage, the entrepreneur will start diverging and the investor will start struggling. I don't know when this is going to happen. I'm also very curious to see how this plays out and when this will happen. But I'm quite certain that when you think everything will go right, whatever that has to go wrong will start going wrong. But I believe that competition and very intense lobbying to enter these businesses are going to put severe pressure on the profit pool, and the government is not going to increase its investment so much that it can accommodate so many new players and such intense competition. So the competition will have to find space in an already crowding opportunity market. So this is a time when I would generally sit out and watch all the fun. I'm not seeing cash flows in any of these companies which are gained 5 or 10x. And to me, whenever you invest ignoring the health of the balance sheet, your balance sheet is going to see a gaping hole, and I dread it. And that's what shows in my video, my thoughts, and in what I'm telling you today. Thank you.